Most people ask the question the wrong way. They ask, should I build wealth with stocks or with real estate? That sounds like a practical question. But underneath it, there is usually a very emotional reason. They are not asking because they calmly studied both systems, compared liquidity, taxes, risk, leverage, cash flow, volatility, legal exposure, and time commitment, then decided they needed a rational sequence. Usually they are asking because someone they know is making money. A friend bought stocks and the account is up. A cousin bought a rental and says the tenant is paying the mortgage. A coworker talks about dividends. A neighbor talks about appreciation. A podcast host talks about real estate tax benefits. A YouTube video makes one path look obvious. Suddenly the person feels behind. That feeling is dangerous. When money decisions begin with the fear that someone else is moving ahead without you, the decision is already compromised. You are no longer thinking in first principles. You are reacting to social comparison. I have seen this pattern many times in markets and in life. Something was always there, but once your brain decides it is relevant, you begin seeing it everywhere. You decide you might buy a certain truck, and suddenly the truck seems to appear on every road. The trucks were there before your attention changed. The same thing happens with investing. You begin thinking about real estate, and suddenly every successful person seems to own rentals. You begin thinking about stocks, and suddenly every person seems to be talking about Nvidia, Coca-Cola, dividends, or covered calls. The world did not suddenly change. Your attention changed. That matters because attention can create learning, but it can also create impulse. If attention makes you study, it is useful. If attention makes you chase, it is dangerous. So when someone asks me whether to start with stocks or real estate, I do not begin with the asset. I begin with the sequence. The question is not which asset is better in some abstract sense. The question is which asset helps you become more competent without exposing you to risks you are not yet ready to manage. That is a very different question. Stocks and real estate can both build wealth. Both can be extraordinary. Both can be abused. Both can make people rich. Both can hurt people who do not understand what they own. The issue is not whether stocks are good or real estate is good. The issue is where a beginner should start if the goal is to build skill, confidence, liquidity, and staying power. My answer is usually stocks first, not because I dislike real estate. I like real estate very much. Real estate may be one of the most powerful wealth-building tools in the tax code. It can give you cash flow, depreciation, leverage, control appreciation, 1031 exchanges, refinancing opportunities, step up in basis, and many ways to structure wealth. Done intelligently, real estate can change a family's future, but if you start there too early with too little cash, too little knowledge, too much leverage, and no margin for error, real estate can do something stocks usually cannot do. It can cost you more than your initial investment if you buy shares of Coca-Cola. The worst direct outcome is that the stock goes down and you lose the value of those shares. That is painful, but the damage is usually contained. If you buy a rental property, the risk is different. A tenant can stop paying, a tenant can damage the property, a roof can fail, an air conditioning system can die in the middle of summer, insurance can rise, property taxes can jump, a vacancy can last longer than expected, a lawsuit can appear, a city can change rules, a property manager can disappoint you, a repair can arrive when your reserves are weak, a debt payment still comes due even when rent does not arrive. That is a different kind of risk. A stock can go down, a property can call you and demand more money. That is why sequence matters. Real estate is not bad, it is powerful, but power without preparation is dangerous. Stocks give a beginner something very valuable. They give liquidity, they give small mistakes, they give immediate relevance, they give a training ground. If you buy a small position in a high-quality dividend-paying company, something changes in your brain. The company is no longer abstract. Earnings reports matter. Dividends matter, valuation matters, debt matters, cash flow matters. The price-to-earnings ratio is no longer a term in a book. It is connected to your money. That is how competence begins. Not by consuming endless content. By owning something small enough that a mistake will not ruin you, but real enough that your mind begins paying attention. This is one of the reasons I like starting with stocks. You can build pattern recognition, you can learn how businesses behave, you can learn how markets overreact, you can learn what dividends are, you can learn how income is produced, you can learn what valuation means, you can learn why quality matters, you can learn how to think in probabilities instead of stories. You can learn all of that with a small amount of capital and a liquid asset. That is a good training environment in real estate. The mistakes are often larger, slower, less liquid, and more expensive. A beginner may watch 3 videos, save $30,000, buy a cheap rental in a market he does not understand, then discover that the spreadsheet was fiction. The rent was real, but the repairs were more real. The vacancy was real, the debt service was real, the property taxes were real, the tenant laws were real, and because the property is illiquid, he cannot exit easily. That is how people get hurt. It is not because real estate is bad, it is because they entered the deep end before learning to swim. A principle I use is this: start in the asset class where the cost of learning is lowest, for most beginners. That is stocks. The second principle is this: build liquidity before illiquidity. Liquidity is not a luxury for beginners, it is protection. If you own stocks and need cash in 3 months, you can generally sell and have access to your money quickly. That does not mean the price will be ideal. It means the exit exists. If you own a rental property and need cash in 3 months, the answer is much more complicated. You may need to sell. Selling can take time. You may need to accept a lower price. You may need to deal with tenants, inspections, lenders, repairs, and closing delays. You may try to borrow against it. But that depends on lending conditions and equity. Illiquidity can be acceptable when you have cash reserves and experience. It is dangerous when you are still building your foundation. That is why the order matters. The third principle is that wealth is built in buckets, not one all. In Move, the model I like is a balanced allocation built over time. About 30% in income, producing stocks, about 30% in real estate or real estate exposure, about 30% in managed money or broadly managed exposure, and about 10% in cash or cash equivalents. The exact numbers can vary by person, but the structure is important. Stocks give liquidity, income, learning, and exposure to businesses. Real estate gives tax advantages, leverage, cash flow, and physical asset exposure. Managed money reduces the risk that every decision depends on your personal judgment. Cash gives dry powder, safety, and the ability to survive mistakes or seize opportunities. That last 10% matters more than people think. Cash feels unproductive when markets are rising, but when life hits, cash becomes oxygen. When markets fall, cash becomes opportunity. When a property needs repairs, cash becomes survival. When you lose income, cash becomes time. Cash is not only about return, cash is about staying power, and staying power is one of the most important forms of wealth. People often blow themselves up not because the investment was terrible, but because they had no margin for error. A normal problem became fatal because they had no cash, no liquidity, and no flexibility. That is what I want to avoid. So if someone has less than $150,000 of investable assets, I want them to think very carefully about sequencing. If you have $50,000, maybe your first real job is not to buy one difficult rental with every dollar you have. Maybe the first job is to build competence in stocks, build liquidity, and build cash reserves. Then real estate can come later, or it can begin in safer forms. This is not a rule carved in stone. Some people have higher income construction experience, family real estate background, or access to mentorship. Some people can handle property earlier, but the general principle remains: do not put all your capital into a move you do not fully understand. This is how people lose decades. Now, when I talk about stocks first, I do not mean gambling. I do not mean buying whatever a brother-in-law mentioned at the gym. I do not mean trading options with no understanding. I do not mean chasing a hot ticker because the chart is green. I mean starting with quality. I mean starting with boring companies that have real businesses, real cash flow, and a long history of paying shareholders. Dividend paying companies can be an excellent training ground. A dividend is a simple idea. A business earns money, keeps some for the business, and pays some to owners. When you own shares, you own a small piece of the business. If the company pays dividends, you receive some of the cash flow. This changes the way you think. You are no longer only hoping the stock price goes up. You are thinking like an owner. What does the business earn? Can it keep paying? Can it grow? Is the dividend safe? Is the company over-leveraged? Is revenue stable? Is the valuation reasonable? That is investing, not price chasing. A dividend aristocrat is a company that has increased its dividend for at least 25 consecutive years. A dividend king has done it for at least 50 years. These are not guarantees of future success, but they tell you something about durability, culture, cash flow, and shareholder discipline. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have taught generations of investors how quality businesses behave. They are not always the fastest growers. They are not always the most exciting stocks. But excitement is not the objective at the beginning. Competence is the objective. When you start, making money matters, but becoming the kind of person who understands money may matter even more. That distinction is important. The early stage is school. You buy small positions in quality companies so that the financial world becomes relevant to you. You learn what an earnings report is. You learn what dividend yield means. You learn what a payout ratio means. You learn what a P/F ratio means. You learn why some stocks move in channels. You learn how markets respond to interest rates, earnings, recessions, and sentiment. You learn how to be patient. That education is worth more than the first small dividend. The dividend is not only cash, it is a signal that you are an owner. Now, I like filters because filters protect people from stories. Stories are dangerous because a good storyteller can make almost any asset sound attractive. A filter forces the asset through objective questions. Does the stock yield more than 2% in dividends? Has the dividend been consistent? Has it grown over time? Has the company paid and increased dividends for at least a decade or more? Is the stock in a stable or upward trend rather than collapsing like a falling knife? Are there options available so a more advanced investor can sell covered calls or cash secured puts if appropriate? Is the revenue stable or growing? Is the P/E ratio within a reasonable range rather than absurdly expensive? Are analysts generally more positive than negative? You do not need every investor to use this exact filter. The deeper point is that a beginner should have rules. Rules reduce emotional buying. Rules make you slow down. Rules make you ask why. Rules turn investing into a process instead of a reaction. This matters because people entering the market often do the opposite. They hear a hot idea, buy quickly, then try to justify it later. That is backwards. The rule should come first, the asset should qualify, then you buy. This is how you build judgment. Now, the stock side can also create multiple streams of income if you learn carefully. A cash secured put can allow you to get paid for agreeing to buy a stock at a lower price if it falls there. A dividend pays you while you own the stock. A covered call can allow you to get paid for agreeing to sell your stock at a higher price. A capital gain can pay you if you sell at a profit. That can be 4 different ways to earn from one stock. But I want to be very clear. Options are tools. Tools can build or destroy. A covered call on a quality stock you understand is very different from reckless option speculation. Selling cash secured puts with proper reserves is very different from leverage. you cannot survive. A beginner should learn slowly. First understand ownership, then understand dividends, then understand valuation, then understand risk. Only after that should more advanced income strategies be used. This is why stocks can be a good training ground. The mistakes can be smaller, the learning can be faster, the liquidity can protect you, the relevance can activate your brain. Now, after stocks, real estate can become extremely powerful, but it has to be entered intelligently. The tax code favors real estate in many ways. Depreciation allows you to deduct a non-cash expense. Bonus depreciation can sometimes accelerate deductions. Leverage allows you to control a larger asset with less capital. 1031 exchanges can allow you to defer taxes when moving from one investment property to another. Step up in basis can reduce taxes for heirs if planning is done correctly. Borrowing against appreciated real estate can create liquidity without a sale. This is why many wealthy people love real estate. The asset gives income appreciation, tax benefits, control, and leverage. But the same leverage that creates wealth can create fragility. If the property performs well, debt magnifies your return. If the property performs badly, debt magnifies your pain. That is why a first rental can be dangerous when it represents your entire cushion. A person saves $30,000 and buys a rental. Then the air conditioner fails. Then the tenant stops paying. Then the roof leaks. Then insurance rises. Then the person has no reserves. The property may be a good property for someone with deeper pockets and experience. But for that beginner, it becomes a crisis. That is the sequence error. The deal may not be terrible. The investor was undercapitalized. This is why reserves are not optional in real estate. You need money for vacancy, repairs, capital expenditures, insurance, property taxes, legal issues, tenant turnover, property management, unexpected life events. If you do not have reserves, you do not really own a rental property. You own a liability waiting for the next surprise. Now, some people believe real estate is easier because you can touch it. That is another trap. Being able to see a house is not the same as understanding real estate investing. A house is simple, a real estate investment is not. You need to understand market selection, rent demand, financing, interest rates, insurance, taxes, maintenance, capital expenditures, property management, tenant law, entity structure, asset protection, vacancy rates, cash flow, debt service, appraisals, local regulation, exit strategy. That is a lot of moving parts. If you get one wrong, the cost can be high. This is why I do not want beginners confusing familiarity with competence. Everyone knows what a house is. Not everyone knows how to underwrite a rental. A rental property is not a home with a tenant inside. It is a small business. It has revenue, expenses, legal obligations, operational risk, financing risk, capital needs, customer risk, management requirements. If you treat it like a passive magic box, it can punish you. Now, there are smarter ways to begin with real estate exposure. One is house hacking. House hacking means you buy a property where you live in one part and rent the other parts. It may be a single-family home with extra rooms. It may be a duplex or triplex. It may be a small multifamily property. The rent from other occupants helps cover the mortgage. This can be a powerful strategy because it combines housing with investment. You need a place to live anyway. If the property can reduce your housing cost and teach you landlord skills, you are learning with training wheels. You are close to the property. You understand the condition. You are not buying some distant market based only on a spreadsheet. You have skin in the game, but not in the same way as buying a fully separate rental with no experience. House hacking can create wealth because housing is often the largest expense in a household. If you reduce or eliminate that expense, your savings rate can rise dramatically. A higher savings rate can then feed investments. This is how one decision changes the whole system. Another strategy is the live in improvement strategy. You buy a primary residence that needs work. You live in it, you improve it. After at least 2 years, you may sell it and potentially exclude a large amount of capital gain from federal tax if you meet the requirements for a single person. The exclusion can be up to $250,000. For a married couple, it can be up to $500,000. This can be one of the most powerful tax breaks available to ordinary people. You are going to live somewhere. Anyway, if you buy a property that needs improvement, add value while living there, then sell after meeting the residency requirement. You can potentially build capital in a tax-advantaged way. This is not effortless. You may live in construction, you may spend weekends on improvements, you may need contractors, you may make mistakes. The market may not cooperate. But compared with buying a rental in a market you do not understand, it can be a more controlled way to learn real estate and build wealth. You get utility from the property while also building equity. That can be a good combination. A third way to begin is through REITs or real estate investment trusts. A REIT allows you to own real estate exposure in a liquid, publicly traded form. You can buy shares in a company or trust that owns real estate assets. REITs often pay dividends because they are required to distribute much of their taxable income. This can be a useful bridge between stocks and direct real estate. You get to study real estate economics without locking all your capital into one property. You can learn how different property types behave. Retail, industrial apartments, data centers, cell towers, storage, healthcare, office. You can read financial statements. You can study funds from operations. You can understand debt maturities, occupancy, rent spreads, cap rates, and tenant quality. And if you need liquidity, you can sell shares. Again, price may not be ideal, but the exit exists. That matters. REITs are not perfect. They can fall when interest rates rise. Some property types can suffer. Management matters, debt matters, valuation matters, but they are often a safer learning environment than buying one illiquid property with no reserves. This is why sequencing can look like this. Start with stocks to build competence and liquidity, build cash reserves alongside the stock bucket, use dividend-paying companies and quality filters as a training ground, then add real estate exposure gradually through REITs, house hacking, or live in improvements. Only then move toward direct rentals when you have enough reserves, knowledge, and emotional capacity. That is not slow, that is durable. People who rush into wealth often rush into risk. People who build sequence build staying power. Now, there is another cognitive danger we need to discuss: information quality. Many people read an article or watch a video in an area they do not understand and assume it is accurate. But when they read about an area where they are experts, they immediately notice the mistakes. This is a well-known problem. If you are an expert in tax and you read a simplified tax article, you may see errors everywhere. But when you read an article about real estate, technology, medicine, or law, you may assume the writer knows what he is saying. That assumption is dangerous. The internet is full of simplified, incomplete, or wrong information. AI tools can make this worse because they can produce confident answers that sound authoritative but are not reliable in specific technical situations. This matters in investing because bad information can become a bad transaction. You should not buy a property, create an entity, take a tax position, or use leverage because a piece of content made it sound easy. You need numbers, you need systems, you need expert help. When the issue is legal, tax, or complex, and you need humility. A person who knows a little can become dangerous because he does not yet know what he does not know. That is why I like beginning with investments where mistakes are smaller and education can happen gradually. Now, let us talk about underwriting real estate. A common beginner mistake is to look at rent and assume most of it is cash flow. A property rents for $1,500 per month, and the beginner thinks, great, I have $1,500 coming in. Number, you do not. That rent must cover taxes, insurance, maintenance, management, vacancy, repairs, capital expenditures, and other costs before you even think about debt service. A conservative approach might assume roughly half of the rent disappears into operating expenses and reserves before the mortgage payment. That is not exact for every property or market, but it is a useful reality check. If $1,500 comes in, perhaps $750 is what remains before debt service. Then the debt service must be lower than that if you want positive cash flow. If the mortgage payment is $900 and the property has only $750 after operating expenses, the deal is negative before you even account for surprises. That is not wealth building, that is hope. A good investor does not underwrite with hope. If the numbers do not work, do not do the deal. This principle is simple and often ignored. People fall in love with the property, the neighborhood, the idea of being an investor, or the story of future appreciation. They then force the spreadsheet to agree with their emotion. That is backwards. The spreadsheet should discipline the emotion. If the cash flow does not work, if reserves are inadequate, if the market is poorly understood, if the tenant laws are unfavorable and you are not prepared, if the debt service is too high, then walk away. There will always be another deal. There may not be another chance to protect your financial foundation after one bad deal drains your reserves. Now, people often ask which builds wealth faster, stocks or real estate. The honest answer is that either one can, depending on structure, leverage, taxes, skill, timing, and behavior. Stocks can build wealth quickly because they allow ownership of productive businesses, liquidity, compounding, dividends, and easy diversification. You can start with small amounts and scale over time. You can automate investing. You can avoid active management if you choose broad funds. You can sell quickly if needed. Real estate can build wealth quickly because leverage, tax advantages, rental income, appreciation, and forced equity through debt paydown can combine powerfully. But real estate also requires operational competence and capital buffers. So the better question is not which builds faster. The better question is which path you can execute well without blowing up. A high return strategy that destroys you during the first mistake is not a good strategy. A slightly slower strategy that you can repeat for decades can make you wealthy. This is a very important idea. The best asset is not only the one with the highest theoretical return. The best asset is the one that fits your stage, knowledge, capital, temperament, and risk capacity. For a beginner, stocks often fit better because they are more liquid and scalable. For an intermediate investor with reserves and knowledge, real estate can become powerful. For a mature investor, combining both can create resilience. That is why the 30-30-30-10 framework exists. It does not ask one asset to do everything. It spreads the job across buckets. 30% in income. Producing stocks gives business ownership and liquidity. 30% in real estate gives tax advantages, physical assets, and cash flow. 30% in managed money reduces the risk that you are the sole decision maker and creates diversification. 10% in cash or cash equivalents gives margin, dry powder, and psychological stability. This is not about being perfectly precise. It is about avoiding concentration. Many people build wealth in one asset and then become fragile because their entire life depends on that asset continuing to work. A person owns only real estate and gets hit by a housing crash, tenant law changes, or debt refinancing risk. Another person owns only stocks and panics during a market drawdown. Another person owns only a business and gets wiped out by one industry shift. Diversification is humility. It says, I do not know the future perfectly, so I will not put my whole future in one bet. This does not mean you cannot have a core strength. Some people are exceptional real estate operators. Some are exceptional stock investors. Some are business builders, but the average person should be careful about concentration before competence. Competence first, concentration later, if earned. Now, when you build the stock bucket, the objective is income, and learning dividend stocks can pay you while teaching you. You can also use broad ETFs or managed portfolios if stock selection is not appropriate for you. When you build the real estate bucket, the objective is cash flow, tax efficiency, and asset-backed wealth. This can include direct property, REITs, syndications, or other real estate exposure, depending on capital, knowledge, and risk. When you build the managed money bucket, the objective is to decouple some of your wealth from your personal decision making. This can mean professionally managed accounts, ETFs, model portfolios, syndications, or other structures where someone else's expertise or a systematic approach is used. Some categories overlap. A syndication may be real estate and managed money at the same time. A REIT is publicly traded like a stock but economically tied to real estate. A municipal bond may fit in income, producing assets or cash, like reserves depending on structure. The categories are not cages. They are mental buckets. They help you avoid being overexposed to one decision style. Now, cash and cash equivalents deserve attention. Some people treat cash as lazy. That is a mistake. Cash allows you to think clearly. If you have no cash, every downturn feels dangerous. If your stock portfolio falls and you need money, you may sell at a bad time. If your rental needs repairs and you have no reserves, you may use credit cards or panic. If an opportunity appears and all your money is locked up, you cannot act. Cash is optionality. Optionality has value even if it does not show up as a high yield. In a $1 million portfolio, a 10% cash bucket means $100,000 of flexibility. That can be emergency liquidity, dry powder, or psychological stability. In a smaller portfolio, the amount may be smaller, but the principle is the same. Do not fill the cash bucket last. Build it as you go. If you are building $50,000 in stocks, have some cash alongside it. If you are preparing for real estate, have reserves before the property. If you are moving into larger allocations, make sure liquidity grows with complexity. More complexity requires more cash. That is a principle. Now, we should discuss tax strategy because it is one of the reasons real estate becomes powerful later. The tax code often rewards real estate investors. Depreciation can shelter income. Cost segregation can accelerate deductions in some cases. 1031 exchanges can defer capital gains when moving from one investment property to another. Step up in basis can allow heirs to avoid tax on built and gains under current rules if structured correctly. This is why many real estate investors become enthusiastic. They see that the tax code can make real estate more efficient than it appears on the surface. But tax benefits should not make a bad deal good. This is another mistake. People buy weak properties because the tax benefits sound attractive. The deal must work before the tax benefit. Tax strategy enhances a good investment. It does not rescue a bad one. If the property has negative cash flow, poor location, bad management, inadequate reserves, or excessive debt, depreciation will not save you from reality. The numbers have to work. Then tax strategy can make the numbers better. This is a recurring principle in all investing. Do not use complexity to justify weakness. Now let us think about the psychology of ownership. When you buy a stock, your brain begins to notice the business. When you buy real estate, your brain begins to notice rents, vacancies, repairs, financing, and property values. Ownership activates attention. That is why small ownership can be educational. But ownership also activates bias. Once you own something, you may begin defending it. You may ignore negative data. You may become emotionally attached. You may refuse to admit you were wrong. This is why process matters. Buy with a thesis. Monitor with objective criteria. Sell or adjust. If the thesis breaks, this applies to stocks and real estate. A stock investor should know why he owns a company. If dividend quality deteriorates, debt rises, revenue declines, or valuation becomes absurd, he should reassess. A real estate investor should know why he owns a property. If cash flow fails, the market changes, expenses rise, or management becomes impossible, he should reassess. Ownership should make you attentive, not blind. Now, let us return to the beginning. When someone asks stocks or real estate, I would say this: start with what lets you learn safely. For most people, that is stocks. Build competence, build liquidity, build an income mindset, use high-quality companies or broad funds. Learn how financial statements, dividends, valuation, and markets work. Do not speculate. Do not chase. Do not use complex strategies before you understand simple ownership. Then, when you have more capital and a stronger foundation, begin adding real estate exposure intelligently. Maybe house hack, maybe do a live in improvement strategy, maybe buy REITs, maybe eventually buy rentals with adequate reserves and proper underwriting. But do not take your first meaningful capital cushion and throw it into a property you do not understand. Because someone online made it sound easy. That is how beginners get crushed. The goal is not to become rich as fast as possible in theory. The goal is to become rich in reality. Reality includes mistakes, recessions, bad tenants, market drawdowns, insurance bills, tax rules, liquidity needs, and human emotion. A good strategy survives reality. Now suppose someone says, I can do both. That may be true. You can own stocks and house hack at the same time. You can build a dividend portfolio while living in a property you are improving. You can own REITs before owning physical property. You can invest in ETFs while saving for a down payment. The point is not to create rigid rules. The point is to control risk. If you can do both while maintaining cash reserves, understanding the numbers, avoiding over-leverage, and keeping liquidity, then do both. But do not confuse doing both with overextending. If the real estate project consumes all cash, and the stock account is tiny, and the emergency fund is empty, and the property has no reserves, you are not diversified, you are fragile. Fragility hides during good times. It shows itself during stress. A tenant stops paying, the market falls, a job is lost, a repair is needed, interest rates rise. Insurance jumps, then the whole structure is tested, built, so the test does not destroy you. Now let us talk about why many people are attracted to real estate first. Real estate feels tangible. You can drive by it, you can touch it, you can show it to other people, you can say, I own that house. Stocks feel abstract, you own a piece of a company, but you cannot touch your share of Coca-Cola's factories or Procter & Gamble's brands. This makes some people believe real estate is safer, but tangible is not the same as safe. A house can be tangible and still be over-leveraged. A rental can be tangible and still have negative cash flow. A property can be tangible and still be in a declining market. A tenant lawsuit can be tangible too. Stocks feel abstract, but a share of a high-quality business can be more liquid, more diversified, and less personally demanding than one rental property. The form does not determine the risk, the structure does. That is why you must think in systems. What is the liquidity? What is the downside? What can go wrong? What capital is required after purchase? How much control do I have? How diversified am I? How quickly can I exit? What tax benefits exist? What legal risks exist? What knowledge is required? These questions are more useful than asking whether the asset can be touched. Now, the 20-hour competence idea is useful because it gives people a practical target. You do not need 10,000 hours to begin. You need enough focused effort to stop guessing. 20 hours of focused attention on dividend investing can teach you the basic language. 20 hours of reading financial statements, dividend histories, and valuation metrics can make a major difference. 20 hours of learning real estate underwriting can prevent a disastrous purchase. 20 hours of studying tenant laws, insurance, reserves, and property management can change your view of a deal. Most people will not do even that. They spend more time shopping for a vacation than studying the investment that might use their life savings. That is a mistake. If you cannot give 20 hours to understand an investment, you probably should not put serious capital into it. That applies to stocks. It applies to real estate. It applies to options. It applies to crypto. It applies to private deals. Money should follow competence, not excitement. Now, let us discuss the danger of copying someone else's Chapter 20 when you are on Chapter 1. This is one of the most damaging things in modern investing culture. You see someone with a portfolio of 40 rental units. You do not see the years of mistakes, cash reserves, banking relationships, systems, property managers, tax planning, legal structures, and painful lessons behind it. You see someone trading options successfully. You do not see the years of pattern recognition, risk control, and losses that taught them discipline. You see someone living off dividends. You do not see the decades of capital accumulation. You see the result. Then you copy the advanced action without the foundation. That is dangerous at Chapter 1. Investors should not copy a Chapter 20 strategy without adapting it to Chapter 1 risk. If someone with millions in liquidity buys a distressed rental, that may be smart. If someone with $30,000 total net worth does the same, it may be reckless, same deal. Different investor, different risk. This is why personal context matters. Do not copy the action. Understand the system. Now, a useful way to think about building wealth is like building a bridge. Stocks can be the first section because they teach you ownership and keep you liquid. Cash is the support under the bridge. Real estate becomes another strong section once your foundation can handle the weight. Managed money adds another section that reduces dependence on your own decisions. Eventually, the bridge can carry you across decades. But if you build the heaviest section first on weak supports, the bridge can collapse. That is what happens when people begin with a highly leveraged property and no reserves. They are not wrong to want real estate. They are wrong in sequencing. Now, what if someone already owns real estate first? That is fine. The point is not shame. The point is risk assessment. If you already own property, ask whether you have enough reserves. Ask whether the property cash flows after realistic expenses. Ask whether you have proper insurance and legal structure. Ask whether the debt is manageable. Ask whether you are overexposed to one market. Ask whether you also have liquid assets. If the answer is yes, excellent. If the answer is no, build the missing pieces. You may not need to sell. You may need to strengthen the structure, more cash, better reserves, better insurance, better management, more liquid investments, less leverage, better underwriting. The goal is to become more resilient. Now, let us think about stocks in the same way. If you started with stocks but are speculating, using leverage, buying story stocks with no process or trading options you do not understand, then stocks are not safe either. Stocks are safer for beginners only when used intelligently. Quality, diversification, liquidity, reasonable valuation, income, education. A small number of speculative bets can be fine for some people if sized correctly, but speculation should not be confused with foundation building. A foundation is built on assets you can hold, not tickets you hope will explode next week. That is why the source's emphasis on dividend. Paying companies is useful. It pushes beginners toward ownership, income, and business quality. That is the right learning environment. Now, the managed money bucket is also important because do-it-yourself investors often become overconfident. They believe that because they understand one area, they can manage everything. That may not be true. A portion of wealth managed by a professional, a systematic fund, a broad ETF strategy, or a trusted model can protect you from your own blind spots. It can give exposure to assets or strategies you might not manage well on your own. This is especially useful as portfolios grow. When you have a small account, the main job is learning and saving. When you have a larger portfolio, the main job becomes preservation, diversification, tax efficiency, and avoiding catastrophic mistakes. The game changes as wealth grows. A $20,000 mistake and a $2 million mistake are not the same. This is why systems become more important over time. Now let us bring this back to the Ray Dalio idea of principles. A principle is a rule that helps you make good decisions repeatedly. The first principle is sequence over excitement. Do not ask which asset is hot. Ask which step you are ready for. The second principle is liquidity. Before illiquidity, do not lock up capital before you have margin. The third principle is competence before concentration. Do not put large money into something you do not understand. The fourth principle is reserves before leverage. Leverage without reserves is fragility. The fifth principle is cash flow before fantasy. If the numbers do not work, do not do the deal. The sixth principle is diversification across decision types. Do not make all wealth dependent on your own judgment in one asset class. The seventh principle is tax benefits after economic reality. A tax advantage does not rescue a bad investment. The eighth principle is ownership activates learning. Small positions can teach better than endless theory. The ninth principle is information must be verified. Do not let online confidence replace expertise. The 10th principle is build wealth in buckets, stocks, real estate, managed money, and cash. Each solve different problems. These principles are more important than the argument over stocks versus real estate, because the right answer changes depending on the person, but the principles remain. Now, let us imagine two people. The first person hears that a friend is making money in real estate. He watches a few videos. He buys a cheap rental with almost all his savings. The tenant stops paying. The AC dies. Property taxes rise. The house needs repairs. He has no reserves. He sells at a loss or carries high-interest debt to survive. He now believes real estate is bad, but real estate was not the core problem. The sequence was the problem. The second person builds a stock portfolio first. She buys quality dividend companies or broad funds. She learns financial language. She builds cash reserves. She studies real estate underwriting. She buys a REIT to understand the sector. Later, she house hacks or buys a rental with proper reserves and conservative math. When a repair appears, it is not a crisis. It is part of the plan. Same asset class, different preparation, different outcome. That is the lesson. Wealth is not only about what you own, it is about the order in which you build, the rules you follow, and the risks you can survive. Now, which builds wealth faster? The impatient answer is whichever goes up more. The intelligent answer is whichever you can compound safely and skillfully for decades. Stocks can compound through business growth, dividends, reinvestment, and liquidity. Real estate can compound through appreciation, cash flow, leverage, tax benefits, and debt paydown. The best path for many people is not one or the other. It is stocks first for learning and liquidity, then real estate when the foundation can support it, then managed money and cash to create a balanced system. That is how wealth becomes durable, not flashy durable. Durability matters because the world will test every investor. Markets will crash, tenants will fail, rates will rise, repairs will happen, headlines will scare you, friends will brag, social media will tempt you, online experts will oversimplify, your own emotions will push you toward bad timing. A durable system survives those tests. A fragile system looks good only until tested. That is why I care so much about starting correctly. Starting correctly does not guarantee success, but starting incorrectly can create damage that takes years to repair. Now, if you are at the beginning, do not be embarrassed by starting small. Small is good if it teaches. Buy a few shares of a quality company, buy a low-cost dividend or broad market ETF, if individual stocks are not appropriate. Track the dividend, read the earnings release, understand revenue, understand debt, understand valuation. Learn what the company does. Watch how price reacts to news. Let ownership teach you, then keep saving. Build the cash bucket, study real estate before buying. If you want exposure, use REITs first or consider house hacking if it fits your life. If you buy a property, underwrite conservatively, assume expenses are higher than the optimistic spreadsheet, assume vacancies happen, assume repairs happen, assume you need reserves. If the deal still works, maybe it is a deal. If it only works under perfect conditions, it is not a deal, it is a wish. Now, one last point, do not let the speed of someone else's wealth building push you into a strategy that does not fit your stage. Someone else may be ready for real estate. You may be ready for stocks. Someone else may be ready for syndications. You may be ready for a cash reserve. Someone else may be selling covered calls. You may be ready to learn dividends. That is not failure. That is sequencing. A wise investor respects his current chapter. If you do that, the next chapter will come. If you skip chapters, the market and life may send you back to the beginning with losses. So the question is not stocks or real estate. The question is this: what is the next best step in a system that builds competence, liquidity, resilience, and long-term cash flow? For many people, that next step is stocks. For many people after that, real estate becomes powerful. For many people after that, the full allocation becomes the goal. Income, producing stocks, real estate, managed money, cash. That is a complete system, not a debate. And if you follow the system carefully, you do not need to chase what is hot today. You can build wealth that lasts. That is the real objective, not to win an argument about asset classes, to become the kind of investor who can survive mistakes, recognize opportunity, and keep compounding through many cycles. Stocks can teach you, real estate can accelerate you, managed money can balance you, cash can protect you. Together, in the right order, they can build real wealth, but only if you respect the sequence.